Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, May 30th, 2023. It's 10:02 a.m. Eastern Time as I'm starting the video, and this is, of course, first trading day of the week with markets closed yesterday for Memorial Day. Just a reminder, this is the only day I'll have in front of my desk this week, doing a little what I call mini vacation, heading down first thing tomorrow morning down to the Keys for a fishing trip, and I'll be back Sunday. So I will, anything market moving, I'll get it out to you as I often do during vacation. A couple weeks ago when I was in Kauai, there was really nothing to point out, nothing that really happened in the markets. But I do want to talk about that. I was going to get a couple charts out to you today. But I've had some bullet points here I want to talk about, and regarding the charts. And first and foremost would be the fact there are numerous articles out there. If you follow the financial media, you've most likely seen these. This rally, this isn't a subjective thing. This is factual. Has been largely attributed to quants. Those are trading programs that the computers make decisions on what to buy. They're not humans. They're saying individual investors have sat out this rally now, the most recent ramp up in the markets, and whether this is an AI bubble or not, that's subjective. Certainly, I believe it is, not to the extent some other bubbles have been, but I do believe there is something going on. What I can speak to factually is there are two stock markets right now, and I've read about this as well, but you can see it. There's the stock market rally. Well, anything related to AI. It reminds me very much of the dot-com period, a bubble back in the 90s, late 98, 99 especially, where anything with the name .com associated with it was shooting up parabolic without any rhyme or reason. Fundamentals didn't matter. Everybody wanted on board that train. So you're seeing that to a greater or lesser extent in the AI world right now. Again, and there's many metrics that show it. This is just tech, and it's really the tech stocks that have anything, or at least are aligning themselves or saying that they're should be or will be benefiting from AI. That's what's going on. That to me. Again, I've lived through many market cycles. There are no guarantees. One possibility here with this market is the rest of the stock market could play a game of catch up to these bloated, overvalued, overbought tech stocks. That is certainly a possibility. And I'm going to talk on that and show you where to look, as I did last week. But all right, so a couple points. I'm going to throw this out there in no particular order. So number one, know that is not a healthy sign. I cannot recall. Doesn't mean it has not happened, but in my decades of trading and being engaged in the financial markets, both from fundamental and technical perspective, chart reading, fundamental analysis, I cannot recall a time where you've seen the quant driven almost an exclusive lift. In fact, let me give you some more facts here. This is as per one of the mainstream journal barons. Quant fund buying has pushed the quant funds' net exposure to U.S. stocks to their highest level since December 2021. That is a quote right out of the journal, I believe. What's significant about December 2021? All right, that's when the stock market peaked. There's the S&P 500. Turn off all the lines. And there is December 2021. So again, doesn't always have to end the same way, but I can say pretty emphatically that is a unhealthy sign, and there are myriad of possibilities, again, including the fact that maybe the rest of the market will start to rally. But it just it's a red flag. So you're not seeing trade ideas out of me. I'm going to go over some today, and as I told you, here's what I'll tell you right now. Let me give you some more facts. The Russell 2000. Russell 2000 is the most popular small cap index, and the Russell 1000 is the large cap index. The Russell 1000 year to date is up 9.2% versus the Russell 2000, which is only up 0.7% year to date. That is the widest outperformance between the large and small caps since 1997. So there are some very unusual things going on in the market right now, and at the very least, it would tell me to be very careful. These increase the odds of a abrupt market crash. The other thing to that is one thing that I noticed is you can look at here SPY, or you can go to QQQ. Let me grab that for you. And so again, over the years and decades, I've been through many of these things. This whole debt ceiling thing is nothing new. Quite often it doesn't matter. You don't hear about it and they just bump it up. But this one, has been on the radar. So you follow it lately, and the two bobbleheads, up there in Washington, they've agreed on tentatively a deal, right? But of course, it still has to pass the House and Senate, and there's a good chance it's not going to go through the way it is. So I was surprised that the Biden and company did agree tentatively on a deal, but wouldn't surprise me one bit to see the the works get gummed up going forward. Well, here's what I want to say. When these things happen, and again, similar type things, or the debt ceiling, something else, when you see this in advance of that, when you see the stock market do this, sell off, correct, panic selling because they anticipate gridlock with the debt ceiling potential gut, then a relief rally is justified as soon as everything starts getting resolved and everything is hunky-dory. We never even had anything remotely close to a pre-debt ceiling sell-off, a correction. The market has been steadily rising. They've been talking about it, but yet it's been going up, 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 up. So therefore, common sense or logic would dictate the risk would be to the downside, not the upside, because worst case scenario never got priced in. Only best case scenario that everything's going to be hunky-dory, evidenced by the fact that we never had the market didn't throw a nervous sell-off over the last few weeks. Instead, the opposite happened. Everything was just focused on AI, and tech. And big tech went up, and the algos were buying and buying and buying. As again, is evidenced, not just my opinion. That's you can read up on that. So you have that divergence between large caps, small caps. You have within the tech sector. It's just big tech. It's the tech that's related to AI. Where are the opportunities? So one of a couple things are going to happen. One of many things. The market can kind of trade sideways going forward. The market can correct, it can crash, or it can continue to go up. If it goes up, if you are of the bullish mindset, then I will tell you is what I told you last week. I would look at the bottom tier of the NASDAQ 100, the lowest weighted components, those that aren't really tagged with AI, some kind of AI hype. And that's what I covered for you last week, and I'm going to go over those again. When I look, the most constructive charts, the only charts that I would be comfortable with are some of these, because they are my kind of charts. Again, that doesn't mean that NVIDIA and Alphabet and Apple can't go up anymore. I severely doubt they have a much more upside potential, and I think the downside potential outweighs it more than it has in a long, long time. I think the risk is to the downside, and there's in other words, you could see again 30% downside. I think this year is very likely in big tech and those names. Can they go up 30? Sure, it's possible. Based on the technicals and fundamentals, I don't think so. I think most, if not all, 100, 110, 120% of the AI hype for the near-term future has been priced in. Sure, AI is here to stay, but I'm talking near term. So where I see constructive charts that look better are the ones I covered last week. And again, just look at the bottom tier of not just the NASDAQ. These are the smallest companies in the NASDAQ 100. There's obviously smaller companies in the NASDAQ composite, but Rivian break above 1586. I covered that one last week. And again, Sirius XM, big divergent lows, stocks trading much closer to their multi-week or 52-week lows. So I'm sure there's a valuation play to be made there, cheaper PE ratios, less downside risk. And again, these aren't penny stocks. I'm still picking companies that are, in the NASDAQ 100. So these aren't companies that probably don't have a high risk of bankruptcy or anything like they do when you play with, lower tier companies that are, close to penny stockville. Lucid is another one I like. ZS, Zscaler. I'm just going in order here, but it's coming off that divergent low, trying to take out its 200-day moving averages for the first time. So these are stocks, again, that look better. Personally, I would hold off to the next. I think the odds for a big drop are still very, very elevated right now. And so if that happens, even the most constructive charts tend to fall. You could outperform. And by the way, I didn't mention this before, but it was also mentioned in these articles, the risks with these quant funds. Think of it like Terminator if you want to. The bots doing all the decisions, buying and selling. They are much more fickle and a lot faster than humans. When they decide, instead of hitting the buy button, all at once to start hitting the sell button. If they don't like what's going on with the debt ceiling, or they don't like, for whatever reason, they decide collectively, like they've collectively decided to all buy recently, they all of a sudden decide to sell. Well, just keep in mind that stocks tend to go down much faster than they rise. And we've already seen a parabolic spike recently in the NASDAQ 100, not in the S&P. Again, the divergences are stark right now between a handful of, tech stocks, especially AI-related tech stocks, and the rest of the entire stock market. It is glaring. I just cited you some statistics. So besides the bottom tier of the NASDAQ 100, there's Zoom, beautiful looking divergences, bullish falling wedge. But again, a stock trading not far off 52-week low. We're in a overall bear market, a primary bear market. So you got to be careful with that. So I'm not in love with these stocks. I just think they have a better technical posture. There's a line technology, pull back to uptrend line support right there, and ENPH end phase, positive divergence. And again, so these guys haven't participated. But, on the flip side, this one just broke down to that uptrend line. Where else besides, and you can go through these stocks that have been, again, that didn't participate in this AI ramp lately. The other area would be the small caps, of course. As I just mentioned, we've seen the most stark divergence in performance between the large and small caps since 1997. We're talking, is that 23? That's 26 years, over a quarter century. You've not seen this kind of divergence. So this is a market, guys. If you're new to this, and I don't want to sound like a broken record or doomsayer, be careful. This market is broken. It's not right now. It's not well under the hood. Again, I'm not the only one talking about the almost a single-handed fact that the NASDAQ 100 and most things AI are single-handedly or mostly doing the heavy lift in the stock market. And historically, again, I struggle to recall any time that ended well with that other thing I talked about, the possibility that the rest of the market starts to play a game of catch-up. It is possible. But if you're looking, to hedge, you insist on engaging this market. It's a great time, I think, to stand aside. Me, I told you, I've got to go down. I'm going to be out on a boat fishing and, having a good time down the Keys. So I'm going to be not really engaging this market this week. I will get out any information to you if I see anything big. Maybe I'll, fire off some trades on my phone or laptop if I see an opportunity. But again, this is where you have relative value right now, I think, in the small caps and everything but the big tech. When you look at big tech, here's the NASDAQ 100, the market leaders. I wanted to show you one more thing before I move on to those leaders, guys. The weekly charts. So from time to time, I talk about the weekly charts. That paints a big picture. This one I've shared many, many, many times in the past. This was the end of the bull market right there, the beginning of the bear market. And I laid out these targets on QQQ, T1 through T4. T1 was hit back here. It was support at the time. and we've rallied back to that T1 level. It's 350.70. So support once broken becomes resistance. Keep that in mind. That's where the Nasdaq 100 is, and you also have the S&P 500 at no coincidence at my tier one. I called it near term because I have longer term bear market targets. So, but for all intents and purposes, this first leg down in the bear market right here, there it is. Near term T1 right here was hit. We broke it. Support once broken becomes resistance. Back test 1, 2, 3 weeks right there. Popped it 1 week but couldn't hold it. Fell back below. Rejected 1, 2, 3 candles, and we're there, and we're above it by a very, very slight margin. Again, on almost a suspicious rally that I just, like I said, you just have to kind of question the validity of the recent rally. And the S&P, of course, has the same companies that the Nasdaq 100 does. There are also the top weightings in there. They're just not as heavy weighted. That's Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, Tesla. They're all in the S&P, and they're all the top components there as well. So that's it. I really just wanted to kind of share that, those fundamental bits that more so fundamental. The fact that, again, this has not been natural buying. This has been quant buying. The fact that we have not seen a pre-debt ceiling correction or sell-off. Therefore, again, it seems like the upside potential is already priced in. Maybe we could rally more. I don't know. But when you look at the big picture, the S&P 500 is still well within that max bounce target zone. I just made a mess of it there. There's my max bounce target zone box. And so, like I said, whether I was in front of my desk or not all week this week, I would tell you the same thing. It's just the risks that this market can break either way. It's just not attract the technicals. Certainly make going long, new longs here, even if there's a post debt ceiling rally, you have the big negative divergence. You still have it on SPY, you still have it on QQQ, and that makes the upside outlook, at least until we get a decent correction, just not favorable. The risk reward is not favorable. Yet on the downside, we don't have the sell signals, the same sell signals I told you couple weeks ago, I think even before I left for Kauai, is that you need to, on the 60-minute chart, you have to start getting down here and breaking down back into those these trading ranges here. That's the 60-minute. This is a busy chart here, but you can see this is the trading range, these boxes right here. And so until we start failing back below the top of that range, and especially the bottom, those are your points where this move down below there would sharply, significantly increase the odds that we're going to have that much bigger drop again, to the tune of roughly 30% from where we're at right now in the the Nasdaq 100. And if we go up, if this breakout was a real deal, we did break out above the range and we're above it now. And if we go a lot higher, well, I don't have a lot of targets for you. I can tell you the next target, if I had to give you a target based off the daily chart, I'll turn this line up here. It's about almost 370 right there. Let me make it a little brighter. And you have a reaction high here. And again, the Nasdaq's kind of doing its own thing. If nothing else, I think the most bullish case, in my opinion, for the stock market would be to see convergence between the everything else and the big tech things, Nvidia, Apple, looking to seek some alpha here in this market. Apple, Microsoft, Alphabet is what I was trying to say, Amazon, Nvidia, Meta, Tesla. And so that, to me, if you want to know, Randy, what would your longer term bullish case look like? It would be to see at least some consolidation or outperformance of everything else, meaning the small caps outperform the Nasdaq 100, The S&P outperforms, the equal weighted NASDAQ outperforms. So these guys don't have to necessarily fall. Outperformance can come in two ways. They can just stop going up so much and the rest of the market comes up. That would be a more healthy sign, which would help to support the case that we're going to go to new highs. Unless that happens, unfortunately, my outlook hasn't changed. In fact, these divergences grow bigger, and all these, I'm talking about the divergence on the indicators, but the divergences between a handful of big tech, AI-related big tech, and everything else is extremely concerning, in my opinion, and also sets the stage, I'll just say it, for the potential for very swift and powerful gains if it for whatever reason, whether it's going to be something to do with the debt ceiling, something to do with China, something to do with something else, another blow up of a bank, a fund, anything that sets this market down. I think the market is a powder keg. And so what I'm trying to get at, if you start to see that, and it's almost at this point, since we're so far away from where an objective sell signal based on the charts, I told you that trading range is all the way down here. Something happens, maybe one of the things might be a big bearish reversal candlestick. You see a big red candle that engulfs the previous candle or multiple candles, things like that, or maybe a candlestick pattern. Maybe you see it on the S&P as well. If you get that, then you can always short and just keep your stops tight. That's it. If you want to go long, again, I can't make a case to go long, an objective case to go long these. I don't buy just for the sake of buying. I'd rather sit back, maybe a pullback to that uptrend line right there, if that's what you're looking to get into the Qs. But again, why chase something that's so overvalued, negative divergence, overbought, in a bit of a bubble? Why not go with something that has a better risk reward profile? So then that would be, like I said, small caps and other stocks and within the S&P and even in the NASDAQ composite, just not those that have gone so crazy. So that's it. Yeah, I wouldn't be surprised to see this market crash 10-15% by the time I get back from vacation. I'll be back on my desk on Sunday evening, Sunday afternoon, and again, we'll certainly do a write-up then, and if anything big happens in the Keys, then I'll get something out to you. I'll give you a couple other quick updates. Natural gas, we roll these now. We're on the Julys. Let me make sure this thing's up to date here. I will point out, remember we were here. We had put in a divergent low, as I pointed out. We were moving up. And I said you can buy a pullback to this trend line, but not below it. And then we were below it, and I said you would not be objective. I would not add to natural gas unless we recover that trend line, and we haven't. However, we've now come full circle. This right here, 2.284, is pretty good support. Why is it good support? All these reactions right here. That was that false breakdown I talked about that was bullish. Once you broke down and then recover that level and you backtest successfully, we're there. I very much like natural gas right here. It has pulled back to pretty good support and you have positive divergence. So I'm going to give you two entries. One is right here. Number two would be on a breakout above this small, actually I should extend that line, falling wedge pattern, a bullish falling wedge pattern. You have a beautiful downtrend line. So objective entry 1 is here at support. Objective entry 2 is here on a break of the trend line. And based on the divergences on the long-term charts, this is only a 60-minute chart. Again, this is my minimum and first or next target, but I think there's a potential for more natural gas. And it's easy. If I'm wrong, there's your stop right there. Your risk reward is very, very favorable. Give yourself a little room below support in case they want to, shake out the week, have a little stop raid, they call it. They know all the stops are right there. So you give it a little bit of room and, phenomenal risk reward if it plays out. So that's one of my favorites right now. And gold and silver look almost the same as well. You have, by that I mean, this is a 2-hour chart, 120-minute, but there's your bullish falling wedge, pretty decent support. So you can take it at support, and just like natural gas, also on a breakout above the wedge. So I think time to get back. Remember, we were, got out, shorted the divergent high, trade the pullback, but time to, I think, start adding back exposure to gold and silver. So that's it. And this is where I'm going to wrap up. I don't have a lot of positions, but I'm going to be leaving town, short the Nasdaq 100. I'm not going to go long the Russell now or anything else, because I think a lot of things are going to fall and fall hard when this little robot bubble, or the algos stop buying and they flip the switch and they decide to start selling. I think everything's likely to fall. But I do like gold, silver long, natural gas long, where the stops are on those. And then the NASDAQ 100, that's up to you. I know it's been a bear of a trade to try to short, but that, believe me, when I see only bigger and bigger downside potential, I'll keep coming back to it. I've been stopped out a couple times, back in, and added some back today, and will most likely, before the day is over, or tomorrow, be on the road most of the morning, probably add to those depending on what I see. But again, nothing, you can't bet it too big with all this noise surrounding the debt ceiling. All right, guys, let me get that out to you. If you have any questions, I haven't really had time to catch up to the last couple posts, but put some questions below here. I'll go back, if you have any, and I'll go back in the other last couple posts, try to answer any questions before I leave town tomorrow. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.